All right. Hey, everybody. Sorry we are late to join the call today. Had some technical issues on our side, but we're going now. So if you have to jump off early, we all understand, and this will be recorded, living here on YouTube. So feel free to watch the recorded version as well. But anyway, just getting into this here, we've got our September market commentary for you today. I'm joined here on the call by Neil Kane, owner of our fine firm here. And what we'll be going through today is similar to what we've been doing over these last couple months, in just giving you guys some insight on what we see going on in the markets right now, and how that might apply to you, how you might be able to use that in your own situation. Okay.
Yep.
So we've got Neil with the slides here. Thank you, Neil, for helping out with that. And let's just go ahead and get started here. So, Neil,
That sounds
what do
good.
we see going on in the market right now?
Yeah. So again, sorry about the delay. We're really looking at September, and September is is the worst month in terms of market performance in the calendar year. So if you dial it back and go to the last 10 years, you'll find that September is the only month actually that posts a negative result year in, year out. But if you dial that back, even back to 1940, we still get a negative number there. So essentially, this is a clean chart to show you how each month has performed over the last decade, with September being clearly the worst. And I think September is going to live up to the hype this go around. We've got the election coming, and we've also got a market that performed pretty well all summer long, although we had a pretty significant pullback in August, right? To start August, we saw a huge drop, some serious market volatility, almost about a 10% correction there, which was really short lived. Then we got earnings season underway. We had some fairly positive earnings come out in August. Market recuperated all of its losses for the most part. Additionally, we saw long-term interest rates beginning to drop. We saw a little bit of weakness in the unemployment rate start to come up, which spooked interest rates to go down. Fed also started to talk a little bit about cutting rates, which led to those rates coming down. But really, where we are looking at is the economy is starting to drive this market, right? And we're seeing a little bit of softening, but we're also looking at some pretty positive news in terms of the inflation fight. So inflation is seemingly coming down. Austin, do you agree with that?
Yeah, I would say so.
Yeah. So headline inflation's coming down, core inflation's coming down. We haven't had any scares yet. We haven't had any like big upticks to the high end. So every month we seem to be posting a lower print on inflation. So I think that's leading to the ability for the Fed to maybe come in here in the next month or two and reduce interest rates. However, I don't think the Fed's going to make a massive adjustment here. I think they're still kind of nervous about inflation having a second wave up. And I think you get a slight decrease to rates, which will help not only stabilize the economy a little bit, but it'll probably help the housing market on those interest rates a little bit as well. Any comments to make here, Austin?
Yeah, I mean, we've in the past, if you've been on these before, you may have seen, or we featured a chart that looked at what happened in the 1980s and what's happening right now in terms of inflation. And what the Fed is really trying to avoid is a reacceleration of inflation, like we saw in the late, or the 80s. And so, Neil, I'm on board with what you said there. With people might be expecting fast and furious rate cuts, but I'd be really surprised to see that. I think it's going to be slow and steady with the cuts to make sure they don't cause any reacceleration of inflation.
Yep, agreed. So if we kind of look at where inflation's coming from or where it's seemingly sticky, a lot of that's coming from three main categories. We got shelter, electricity, and then followed by food, where inflation's still kind of printing these, let's say, close to 4 to 5% increases. That's a significant decrease from where we were just a year ago in those categories. So that's very good to see. We see some of the other areas like airline tickets and used cars falling. Utilities are slightly higher, but not well within that 2% target. But I think for us to see us go down to the 2% range, which is where the Fed wants us to be, we've got to see that shelter and electricity decrease as well. And I don't see a big reason why that shouldn't be the case around this time next year. So all things are looking positive when it comes to inflation. I don't think that there is um, any risk that we're currently seeing that would flip this to go the other way. And I think that's where the Fed's finally starting to get comfortable and why their language has been, hey, let's start to cut. However, not everything looks great. So, Austin, why don't you talk to us a little bit about what's going on in terms of jobs and the economy?
Sure. Yeah. And this is another thing that the Fed is going to be taking into account when they're thinking about rate cuts. One thing about rates being high is it stifles the economy, right? That's truly what it's meant to do. It's meant to slow things down so prices get back under control. So something we've been seeing is early in 2023, 2024, we were saying, man, rates have been high and it's had no impact on the economy. Everything's been hunky dory, really strong. But what we've started to see is that delayed impact of rates being higher for longer, and we're starting to see job growth is really slowing. Okay, the labor market is softening a bit, job growth is slowing, and on top of getting back, lower numbers, something that happens, with these labor numbers is they get released once a month, but really not all of the data is in at that point. Part of it is kind of an estimate, and then a couple months down the road, there will be a revision to a more accurate number. And what's been happening over these last couple months is we've been getting lower revisions, meaning the estimates that we're using to kind of fill in the gaps, in terms of earnings, not only are coming in lower, but are being revised even lower from there. So we're getting to this point now where we're really back towards the average of pre-pandemic. And what will be interesting to watch over these next couple months and quarters is, do we level off there, in this comfortable zone, or do we continue down to the point where we really start to see stress on the economy? And if we go to the next slide here, we can see that historically, and I was talking about this relationship between interest rates and the economy, and we can tie that into the S&P 500, right? And raising interest rates puts pressure on the economy, puts pressure on jobs. Lowering interest rates eases that pressure. Typically, the market does better when interest rates are lower. Okay, but there's kind of a misunderstanding about this in a lot of minds, where once we lower rates, we feel like that should ease this pressure and the stock market should take off. That's kind of what you've been seeing happen in the market, right? Every time we talk about lowering rates, the market rallies a bit because of that, because we get this understanding that there's going to be some pressure. There's going to be some pressure easing in the economy. In reality, what we've seen, especially since the 90s, in these last handful of times rates have risen and then cut back, is that the Fed has been potentially too late in that rate cutting cycle, and it's right on the precipice of a recession or within a year of a recession. So we can see here in 2001, And then the same thing in '08. Rates had actually started cutting, and then a couple months later is when this recession actually began. And it's because rates start cutting because the weakness is noticed in the economy, but we can't necessarily cut fast enough. All of our issues can't be solved by rate cutting. Okay, so I'm not showing this to scare you or to say a recession is coming down the road, or anything like that. But we don't think we're out of the woods yet, in the way that maybe some people do. Okay, so just looking back over history, rate cutting does not necessarily signal, we're out of the woods. Okay, now,
Right. It's
anything to add
interesting
there,
to,
Neil? Yeah.
I mean, it's just interesting to look at this chart going back to 95, where you see these rates coming down right before recessions, and then that's leading the markets lower in most of all those cases, even including COVID, right? COVID was obviously this dark horse that came out of nowhere, but it looked like the economy was kind of on the brink of having a slowdown or a recession there regardless. And then, of course, came the stimulus and all those other things, which made that very short lived. So I have to agree with you here. Just looking at this, it just looks very similar in a lot of cases to where we had those tops in rates, then we had the reductions, and then shortly after that, markets were down as opposed to up.
Yeah. Yeah. Well, and in addition to that, right, we focused on the on our last commentary. If you were on that, and if you're not, you can go back and watch it on YouTube. I know it's last month's commentary, but it's still relevant, right? We were talking about some of the other economic factors that are softening a bit here and playing into this rate cut discussion. So I think there's an important connection here between, they only start cutting rates when the economy has softened to a point where they feel like they can do that without inflation getting out of control. And that's a bittersweet, that's a double-edged sword, right? So it's
Yeah.
important to understand that. And on top of that, on top of the economy potentially softening right now, the other thing that we've talked about a handful of times now, but I wanted to take a little bit of extra time on this webinar to explore this, is the idea of the market being overvalued or undervalued, or things being expensive or cheap within the stock market itself. Okay, so we have these macro trends, right, of the market moving up and down over time related to economic cycles, things like that. Then there's also this fundamental piece about understanding investing in the market and understanding whether you're buying something while it's expensive or buying something while it's cheap, right? And the easiest way, I think, to understand that, or to look at maybe one figure and understand whether something is expensive or cheap, is to look at the price of that company, what's it trading for, and the earnings of that company. And that gives you one number that we can look at to gauge whether something is expensive or not. And that's the price to earnings ratio. Okay, so we've looked at this a couple times and we've brought this up, but I thought this comparison did a good job of visualizing it. Okay, so if we had two shops here next to each other, right? We've got Bill's bike shop and we've got Sam's scooter shop. These could be these are relatively in the same industry, right? You would think they would be valued at similar prices. Okay, so we've got Bill's bike shop here at $60 a share. Okay, that's the price, and we've got Sam's scooter company at $75 a share. Just looking at that number alone, you would think that Sam's scooter company is expensive, right? It's the more expensive buy. $75 as opposed to $60 seems like Bill's company at $60 a share is a better deal, right? Well, that doesn't tell the whole story. You also need to know, if you're buying an investment, you're buying a company, you need to know the earnings you are getting. Even though these companies look similar, they've got different earnings. Okay, the earnings for Bill are $3 per share. Okay, you're paying $60. For that $60, you're effectively getting $3 a year back in earnings. Okay. For Sam's Scooter Company, you're getting $5 a share. So there's a higher level of earnings per share. So when we look at that and we see, okay, what's our actual earnings per dollar that we spend on this, we can see that we're actually getting more bang for our buck. Okay. Sam's, we're paying 15 times the earning for the scooter company because we're getting $5 back, but we're actually paying 20 times the earnings for Bill's Bike Shop. So even though the prices here are cheaper for Bill, we are getting a better deal. We're getting a better bang for our buck for Sam. All right. Now, how does this play into the market? Well, one thing we've been talking about is the potential overvaluation of some of these big tech companies. So what does that mean? Well, a lot of these, we've been seeing companies like Apple, Amazon, Microsoft, their prices this year have skyrocketed, right? People are willing to pay really high prices for these companies. But what's the other piece that's important to know? It's the earnings, right? Have the earnings increased or decreased? So if we look at Bill's Bike Shop, for example, and let's say, the price on this increases to 90, but the earnings has not increased, right? The earnings stays at 3. That would mean this PE number would become 30 times. And that's a way we can look at this and say, wow, that PE number has gone up too high. That means the price is increasing without the earnings increasing. Okay. And that's a red flag for somebody in our role that's choosing the investments and saying, I don't know if I want to pay 30 times earnings when there's a company over here that I can buy for 15 or 20 times. What these companies are saying, though, and what the people that are investing in them are hoping for, they're optimistic about, is that they're allowing the price to increase in anticipation of the earnings also increasing. Okay. So they're saying, you know what? I'm willing to pay $90 for this because I think this earnings is going to double from $3 to $6. Right. Now, that's all well and good, but what we're nervous about right now, especially with these potentially softening economic numbers that we're looking at, is there actual economic support? Is there a good enough argument for these earnings increasing to keep up with the prices that we've been paying? Okay, so Neil, if you could go to the next chart here. We talked about how, interest rates correlate to recessions and things like that. Now I want to look at this from a valuation standpoint. Okay. That price to earnings multiplier. Remember, higher multiplier is more expensive. Lower multiplier is less expensive for the amount of earnings. Now, historically, the S&P 500 averages somewhere between 16 and 18 times. That's the price to earnings multiplier. What we can see here is whenever that multiplier gets above this 25 times average, there tends to be a pretty dramatic come down from that. You can see that happen, back early in the market years, back in the 1930s. But then you can also see that happen in the early 2000s. This was the kind of the tech bubble here. All the tech companies got really expensive and they came back down to earth. You also saw that happen back during COVID. Another thing that I want to mention here is if you look at these gray bars, these are recessions. Okay. When a recession happens, there tends to be a massive compression in valuations. And what that means is when there's a recession, people really care about getting the most bang for their buck, right? They're not as optimistic about earnings catching up with growth. They want to be paying for earnings that you're currently receiving. Okay. So there's a compression of, and so Neil, if you could actually go back one to that last slide. In this situation, what we might be seeing is now people are looking at Sam's Scooter Company and Bill's Bike Shop. And even if Bill's Bike Shop is growing and their earnings are good, they might be saying, you know what? I can pay 15 times for Sam Scooter's company. Bill, you're only getting $3 of earnings. I think your price should be lower so that your price to earnings ratio goes down, right? And this is the message that we've been kind of preaching these last couple of months, honestly, these last 6 to 8 months, is even if there is a recession, okay, and it wouldn't take a massive recession, and it wouldn't take actual negative earnings. These companies that we've been seeing do so well, they wouldn't have to give bad results for their price to actually come down. All it would take is people not being willing to pay as high of a multiple. Okay. And so this is visualizing that there. And that's typically what happens in recessions. So we're not saying, hey, we're going into a recession, but we're saying if we do, expect to see some compression here in terms of these valuations. So Neil, yeah, go in one more here, unless you have anything to add on that one. I just had I wanted to highlight here specifically what I was mentioning about some of these high flying companies this year. Okay, this year we've mentioned sometimes we call it the Magnificent Seven, sometimes we've called it the Magnificent Six or Eight or 10. Really, it's the top 6 to 10 companies.
Each month we want to have a different name for them, Austin.
Yeah, well, we aim to have a different name for it each month. In reality, it's the top 6 to 10 companies by size in the market, right? And right now it tends to be a lot of the big tech companies, Microsoft, Amazon, Nvidia. Nvidia has been all over the news, right, as one of the big ones. And what we can see right now is this chart particularly looks at the top 8, and the average price to earnings ratio, that multiple, is 30 times right now for those top 8, 30 times earnings. And if you exclude those top 8 and you just look at the rest of the S&P 500, it's just over 18 times, which is right around, which is pretty close to our historical average. Okay, the concentration here in these top companies and those companies being at a relatively high price makes us a little bit nervous. If things start to slow down here, that compression could be a potential issue, going into the next phase of the market. So if we go one more slide here, this is just to put things in perspective on how much of the market is actually in these companies that we're calling relatively expensive. Okay, so if you look at the 7 companies over here on the left in this pie chart, right? 30% of the S&P 500, over 30% now. That is actually a little old. Over 30% of the S&P 500 is in these top 7 companies. Okay, when we explain that to the top 10 here, it's closer to like 35%. Over a third. When you invest in the S&P 500 or you invest in the C fund, in the TSP, and we might sound like a broken record here because we've mentioned this on the last couple of calls, but we think it's important. Okay, when you invest in the S&P 500, that fund is weighted by how large these companies are. What that means is when you invest in the S&P 500, a third of your money in that fund is going into the companies on this page right now, right? There's 500 companies in that index. You feel like you should be getting broad diversification, but in reality, a third of it is right here on this page. And so if a third of that money is there, and additionally, these companies are relatively expensive, there's some risk there. Okay. Now, one thing I want to be clear of, and I say this every time because I always have people come and ask, do I need to get out of the C fund? Do I need to get out of the S&P 500? All of this? No, that's not what I'm saying here. Okay, like we still believe in the U.S. market. We still believe in these companies over the long run, but this is something that if you've been chasing these returns over this last year and you see the S&P 500 was up 20%, but you weren't, and so now you're trying to get in now to get some of that money, that may not be the right move. Okay, depending on your situation, you may be a little late to the party there. So we're not necessarily saying, hey, everybody get out. Don't hear that. Okay. This is just saying, hey, let's make sure that your risk tolerance is such where if we did see a pullback here, you'd be able to stomach it. You've got money in other places. It's diversified, right? So that's really why we keep showing this, because this is different than normal, all right? And the impact of this, if we go one additional slide here, and I think this is the last one I really have on this topic here, but the impact of this is volatility, right? If anybody's been paying attention to Nvidia has been a wild story over this last couple of years, right? Every company who's investing in artificial intelligence is using Nvidia products. Okay, they're using Nvidia chips to train their models. That's why Nvidia has been such a household name this year, and why the stock is up like 200% or something, and now it's one of the biggest in the world. But this is an example of what can happen when we get to this frothy place in the market where the prices are so high. Nvidia earlier or late last month released their earnings. Their earnings were massively positive and better than the analysts even expected them to be. Okay, they something like doubled their revenue over the last year. They gave massive expectations for what they were going to bring in the future that was higher than initially thought, and their stock dropped 10%. and it's because the market gets these huge expectations of things in the best case scenario, or better than the best case scenario, gets priced in, and then when anything under that gets released, there's a reversion back to a price that makes more sense. Okay, so this type of volatility is what we start to see and what we expect when prices get high. Okay, so again, I'm not making an all-encompassing statement, say get out of tech here. I'm just saying be mindful of what you're invested in. Okay.
I think an example too, like NVIDIA, it could be used almost as an example for the entire S&P 500 right now, with that 34% being in those 10 companies that, look at the drop in NVIDIA just in a couple weeks, right? And that was based on super exuberant expectations of NVIDIA. And even though the news from them wasn't bad, it just wasn't, I guess, excellent, it dropped. So you got to kind of look at that in terms of the overall market, right? If the backdrop to the economy isn't super great either, how can those companies that are priced essentially for perfection grow at the rates that they've been growing, or the expectation of their growth rate? So then there's kind of the reversion back to mean, and just look at this, right? You go from $130 to $111 in all but what, 5 days there. That's what, a 15 to 18% correction on NVIDIA, just like that. And,
Yeah.
and the news wasn't even that bad. So as these stocks have created kind of the lion's share of the S&P 500, yeah, a 20% drop is easy in just a short amount of time. And that's where you get these super big drops when economic news comes in not good. It doesn't just have to be not excellent. It just has to be not good. And then you have yourself a pretty severe correction.
Yeah. And Neil, I know I switched up the order a little bit, so sorry about that. But do you want to talk about the next one too? Just the trend that we're seeing right now. I feel like this fits with what you were just saying about some of these tech names.
Yeah. I mean, we could kind of just talk a little bit about what's going on across the board in terms of the tech stocks. They are beginning to show signs of weakness. The overall market is starting to stage a little bit more resilience than it has been all year. And you're seeing some of the outflows from some of these big tech companies come back into the overall market. So when we talked about the market cap indexes versus the call it the equally weighted indexes, you're starting to see the equal weight index outperform the overall market by about 2%. We've seen over the last couple of weeks here. So I don't know if that's going to be the start of the trend or if this is just a fake reversion back to the mean. But I do think at some point we do get that reversion back to the mean, which is why we are banking more on the equal weight index versus the market cap moving forward here. So Austin, looks like you pulled up a live chart here. Do you want to talk about that?
Yeah, I was just, while you were talking about that, Neil, I know we had mentioned kind of talking to that a bit with the equal weight index and the market cap weighted S&P 500. So I wanted to show what that really looks like live here, and so to give you guys on the call an idea of what we're looking at here. Okay, there are two primary charts here. Okay, in blue, we have the normal S&P 500. This is like the C fund and the TSP. This is the market cap weighted S&P 500. The way we normally look at it. Okay, meaning if the largest companies in the index have the highest weighting. Then in this pink or peach color, we have what Neil was just referring to, which is the equal weighted S&P 500. That's if you took the 500 companies in the S&P 500 and you gave them each an equal percentage, no matter how large they were. In our mind, that's a better indicator of what the broad economy is doing when you give each company equal weighting. And what's really interesting here, if you look at this chart over the last 20 years, right, since 04, 05 is the big 2008 market crash, right? It includes COVID. And you look at the comparison between the equal weighted index and the market cap, the normal S&P 500, the performance of those is very, very similar from beginning to end. But you actually see the market cap weighted index tends to outperform over time. There's big swaths of time here that it outperformed, specifically around some of the market crashes and the rebound from those crashes. Having broad market exposure was really beneficial. Now, if we zoom in, like what Neil said here, to this last month or even this last like 5 days here, you can see the equal weighted index starting to pull ahead again. Because if we look at the last, actually, I'll go to year to date, right? The main S&P 500, this blue line here, the market cap weighted index, has far exceeded the equal weight because these large companies have been exceeding everybody else in terms of returns. Okay, now we're finally starting to see these come back together as they usually do. It's usually a cyclical thing where they separate and they come back together. So we're seeing these come back together as they normally do, which is why we've been preaching in these commentaries, having that broad exposure, being more diversified, not having everything in the S&P 500 or trying to chase returns there, but having a more broad approach with that. Neil, do you have anything to add while I have this chart up here?
No, I mean, just to address kind of a viewer's question there about an all-season approach. This person's taking some allocation towards long-term bonds, 30% stocks, 15% intermediate bonds, and gold and commodities. This is what I guess has been talked about in Tony Robbins. Like, I don't even think you got to get that creative about it. I think really the concept here is that we're trying to at least allude to here is broad diversification across your stock portfolio. I think is going to be the best method here for the next year or two as the S&P 500 approaches these historical concentrated positions. If that does get unraveled, we think that's going to happen mainly from those top 10 positions bringing down that market a little bit more than the overall market, just because of the PE ratio, going back to what you explained, Austin, is really pumped up there in those top 10 positions. So if you want to use alternative investments, gold, those types of things, commodities, sure, but there is other risks involved in those other positions as well. They do have good non-correlating properties associated with them, but mainly we just want to see folks take broader allocation exposure across their stock portfolio versus the market cap indexes, which have those big weightings. All right, where are we, Austin? Should we load up the slides again? Is that where we are?
Yep, I'd say yeah. Let's get those slides back up, and we can wrap it up with some questions. I think we always just finish with the reminder, like what Neil just said. When we're going through these, it's not to say, hey, you should do this or you should do that. Mainly, what we're saying is, hey, diversification's really important. When you see one segment of the market or one thing really flying up for the year, our tendency is to try to chase that. I think a lot of times as investment managers, we try to help people moderate their emotions, and a big that I feel like that primarily gets focused on when things are going poorly, right? And we're saying, hey, moderate your emotions, don't sell when the market's down, things like that. But it also really impacts us when things are going well. We have this fear of missing out in the market. You're seeing these stories on the news of this person made this much money, or the market did this, and chasing one thing or the other rarely lends itself to long-term success. So we'll put these up here, right? Maintaining that balance between growth and value, being mindful of the concentration risk, knowing what you're invested in and how that is actually invested with these funds. Having some small cap, mid cap exposure. You can do things like that through the TSP. International is a little bit harder through the TSP, just because actively managed international tends to do better. But if you have the ability to have some actively managed international, that can be a good, diversifier right now. Something that we'll focus on in one of these next couple presentations is bonds. We haven't gotten into that in a while, but with interest rates dropping, bonds start to look a lot more beneficial. So another thing, the F fund, specifically in the TSP, bonds have looked horrible over the last 2 years because bonds do not do well when interest rates are climbing. Okay. Bonds do very well when interest rates are dropping or when they're stable. So just because you're looking at these past 10-year returns or the past 5-year returns, you've seen the F fund do so terribly. That doesn't mean it's destined for that future, right? Now's a pretty good time to be considering that as part of the portfolio. So, we share these each time. I think they're just as relevant now as ever, but keep that level head, keep a diversified approach.
We're seeing a strong comeback in bonds just in this last half of the year. So that's probably got a lot, still a lot more legs to it, depending on what the Fed does. But either way, you've got great starting yields on bonds. Still, they've come down a little bit, and that's led to some of the price appreciation, price action on bonds, but still think there's more legs on that trade. And we've been proponent for bonds pretty much all year long. Finally, we're getting what we want there, and we're also getting what we want on the market cap versus the equal weight. But it'll still take a little bit for some of these trends to kind of show themselves. So lastly, we'll just kind of like always end where we end. If you guys got questions, other folks that really aren't current clients of us want to get a freebie check-in, this is the offering that we have. You can really go over many different issues. If you're current clients, feel free to reach out with questions. We'd love to hear from you. That's pretty much it for today, Austin. We've got this upcoming commentary slide here just for you guys that are not YouTube subscribers of our channel. It really helps us for you all to in our algorithms to, number one, be subscribed, but also like the video if you can like this video, I know you're on YouTube right now, that just adds to that algorithm. This channel's brand new this year. So, we're at 500 subscribers and counting, but our competitors are at tens of thousands. So if you can help our cause by liking and subscribing to our channel, that would be fantastic. Other than that, we are done for today. Sorry for the tardiness. Had some internet issues. Had to scramble a little bit, turn off computers, reboot. But all in all, I got the job done, and we hopefully will not do that again. But it is what it is sometimes. New age type of problems. So see you guys in our next session. Austin, any last remarks before we end?
Nope. Thanks, everybody. We'll see you next time.
Okay. All right, guys. Until your next video here. We'll see you soon.